and Jason Yarusi of Yarusi Holdings, a multifamily investment firm here in Tennessee, specifically targeting multifamily investment and multifamily development here in the Southeast, predominantly between Nashville, Atlanta, and Louisville. Since start, we've acquired over 2,000 units, predominantly in these three main markets that we focused on. And we focused on finding value-add opportunities where we can go in there and improve the operations of the property, whether it be on the management side or the property side itself. So today we're very excited to dive in with you. All right, so let's dive in here on the effects on rising interest rates and a rising interest rate environment. So what this does is it affects the properties we can buy. Ultimately, here our loans and our cost for doing business is getting more and more expenses. And what this does is it makes us have to really look at these opportunities to make sure that they are going to work. Make sure that when we get into them, that we're not upside down out of the gate. And especially here, if you were taking on floating rate interest rates right now, you may be exposed to a lot of just fluctuation here happening in the market. So when we take on real estate, one of the things we want to be able to control is we want to be able to control the impact of what we're doing for the improvements here. But if we have an interest rate that's a very high interest rate or a floating interest rate that it could be subjective to market dynamics, to what's changing in the market, it may impact our cash flow for our property. It may hurt us for what we're able to do with the property. So we may be improving that property, but at the same time, because the interest rates rising so much, the improvements may not be matching to the level of the rising interest rates. So as you're looking here at your real estate projects and you are buying new opportunities, the effect of this is that ultimately you have to look at it from a buyer and seller standpoint. The seller may still want their price, and at this time today, it may inhibit you being able to afford this property because lenders on the other side with the rising interest rates, well, that's going to hurt your debt service coverage ratio. That's going to hurt your ability to cash flow. So lenders may, in fact, if you do still want to get this property at that same price point, it may hurt your loan to value. So instead of before being able to get 70% loan to value at maybe a 3.5% or 4% interest rate, where you could meet a debt service coverage ratio that would work for the bank. Maybe it's a 1.25 or 1.3% or 1.3 debt service coverage ratio. Now, because the interest rates have risen up to 6.5% to 7%, higher than that, potentially on some of these projects, that may push down your debt service coverage ratio to a 105 or a 1. And for the bank, for it to make sense for the bank to go and lend for you on this project, they may say, well, listen, at 75% or 70%, this doesn't work. This doesn't work for us because it's outside of our box. You're not able to meet the debt service coverage ratio that we require. So what they're going to do is they're going to come back to you and say, well, to do this, we're going to have to cut our proceeds to you. So in fact, we're going to cut our proceeds down to 60%, maybe 55 or 62 or 65. And on that fact, you have to bring more equity. And if we talk about a cost of capital, typically the equity is more expensive. You having to bring more equity now may hurt your returns that you are offering back to your investors and may not meet your return threshold. So now it becomes that pendulum effect here of that with the rising interest rates, you may have to go back to the seller and say, listen, if you still want to do this deal, ultimately, we are going to have some negotiation of coming to a more reasonable price that it can make sense for you to meet your numbers. So as interest rates continue to rise, it's important to make sure that your project can sustain, make sure that the increases to the project you're going to do is going to be able to sustain at a level that, of course, you can meet debt service coverage or expenses and still meet the return expectations you have for this project today and into the future. So noting this, best thing we are always looking to do is have a lot of exposure, talking out there to any of the lenders that are in our network and meeting new lenders. Lenders are not all one for one. You're going to have different lenders that are having different opportunities that may be more open or less open right now to lend to you and your projects. Some may be more apt to only want to lend on projects that are in their backyards, and some may be pulling back from doing development projects. Some may be pulling back from doing big renovation projects, and some may be solely looking to be lending with people that they have a pre-existing relationship with. So that said, It's very important to know what you're working with, who you have as your tools, as your resources to be able to go out there to talk to, so you can be clear on the effects of the loan and the interest rates that you potentially can get on the offerings that they stand today. So keeping your head on the swivel, getting out there, staying active, putting the work in to know what is happening out there in the lending world, so you can make the best choices about your projects for yourself and for your investors. All right, let's do this.